Good morning. I should say good day to you all, especially the attendees and the panelists. We have people from as far as Australia to well, I know people from the UK who've joined this call. So let me start with thanking all the attendees and the panelists, and we'll get very shortly to introducing them. But at the start, let me thank the Citi team, who've pulled this webinar together with us at Arthur D. Little, and we're hoping that in the future we'll do many more of these in the areas of banking, fintech, and others. A quick introduction about myself. I am the head of financial services in the MENA region, which stands for Middle East and North Africa for Arthur D. Little. I'm based out of Dubai. And before we get into the call, let me give a little bit about the structure of the call. So we're intending to run this call for about 75 minutes, which includes Q&A. I would encourage all the participants to start sharing their Q&A from the get-go. Our panelists feel very confident that they want to answer live questions rather than run an over-choreographed event, which is great. So I think it will be interactive and enjoyable. My request to the panelists, and I think they've already done, is please stay on mute when you're not talking, but then do unmute yourself when you do start talking. Otherwise, you'll be hearing me going again and again saying, unmute yourself. More importantly, let's have a good time for the next hour and a half, or hour and 15 minutes. On the topic of BNPL, I think there isn't much that I can add except sort of borrow the statement or borrow a quote that love it or hate it, I think it's hard to ignore it, whether you're a consumer, whether you're a merchant or a bank, and increasingly the regulator. I do not know what the most popular fintech trend has been of 2020, but definitely from a news cycle perspective, BNPL has sort of captivated the audiences who are interested in this topic. So with that, I'm going to hand you across to my capable co-host and friend, Ronit Ghose, who will introduce himself and the panelists, and then we'll get on to the call. Ronit, over to you.
Great. Thank you, Arjun. Thank you to the AD Little team for pulling this together. Arjun was the moving light behind this event. I'm here as his wingman, as a sidekick. So I'm responsible for global banks and fintech research globally for Citi, but I'm also, like Arjun, based in Dubai. We've been discussing BNPL and many other fintech topics during lockdown, and decided to pull this panel together. It's my delight, my pleasure to host, and I'm just going to very briefly introduce the speakers. I'm just going to do it in the order they're showing up on my little tiles on my screen. So this is in kind of alphabetical order. So starting with Hosam. Hosam's based here in Dubai, the founder of Tabby, a serial entrepreneur, and is one of the sort of moving lights behind BNPL in the UAE and Saudi Arabia. Simon's zooming in from Australia today. Simon is a director of new markets for Zip. Australia, obviously a leading force in BNPL internationally, as you know, and we'd love to hear Simon's thoughts, not just about what's happening in Australia, but their plans around the world. Then Nitya is zooming in from Bangalore today. Nitya is the CEO and founder of Simpl, and so it'd be really interesting to get a perspective about BNPL in India. And last but not least, David. David is a CEO for Atome. And David, you're joining us from Singapore today. So thank you everybody. It's a truly international panel. We don't have representation because of time zones from further west, but we will get to that in another session. Arjun, back to you to kick us off with questions.
Sure, thanks, Ronit. So why don't we actually start with Simon? Because I think what's very interesting about Zip is that you're not only in Australia and New Zealand, but through your Quad Bay acquisition, you have a presence in the US and you're obviously in the UK. So Simon, if you could, and I know it's sort of hard to bring these several markets, if you could sort of start with sharing some sort of interesting market consumer drivers behind the surge of BNPL that you've seen across these various markets, and any insights that you can give in terms of target customers, demographics. Is it only the Gen Zs, or are older folks like me also sort of getting into the getting into using the product? So be very keen to hear your view.
Yeah, and firstly, thank you for the opportunity to present and speak here today. Excited to participate. Yeah, I think as you mentioned, Arjun, over the last 12 months, Zip has had a real focus on international expansion, and a theme that generally rings true across all the markets that we're in that you mentioned before, and some of the other markets that we're looking at, is that millennials and Gen Zs who are looking for a seamless, fair, and more transparent payment experience are really driving the adoption of buy now, pay later. But in saying that, in Australia, you may be surprised to hear that the profile of our customer is, the average age is 32 years old. It's female, and they're in full-time employment. And really what they're looking for, and that's our average customer, really what they're looking for is products that enable them to gain more control and flexibility over their finances. And even when we look to the UK, where we recently launched the business there, another statistic in terms of the consumers that are using and considering buy now, pay later is that 1 in 3 Brits under the age of 45 are currently using buy now, pay later services in the UK. And so whilst, we hear and see a lot of talk about Gen Z and millennials, and that is a driving force behind buy now, pay later, it certainly isn't exclusive to that group. And we are seeing an older demographic using it. And as I said, the average age in Australia, female 32, is probably older than what most people would have expected.
Nitya, you're in India, huge country. I don't know, last census was, I don't know, 1.5 billion or whatever it is. Different to a lot of other markets where our panelists sit. Give us a little bit of insight on what's going on in India, especially from a consumer perspective.
Yeah, no, absolutely. So I think I would take two-step approach to it. One is, I think I would like to resonate with what Simon just said. What is the macro-ist driver? Why do we have buy now, pay later in India and Australia and UK and US and Japan, everywhere else, in spite of the fact that the market dynamics are different. Different markets have different credit card penetration. And I think that driver is, and when you think about the driver and the early adopter, is definitely, as far as we can see, the millennials and Gen Z, who are used to interacting with products, especially online, that resonate with their value propositions or their values. And those values are high quality consumer experience, high degree of trust in the service, and high degree of control when they do anything online, right? For instance, you press a button, a car shows up to your house and takes you wherever you want, and it's all safe and great, right? You can swipe your phone right, and you have a girlfriend or boyfriend, almost every hour, right? And when you think about a consumer who's used to doing that, and then you think about then interacting with financial services or payments, it is a different world, right? And that's where we are seeing the early adopters, right? The millennials, the Gen Z, who are looking for that user experience, looking to interact with products that align with their value systems, is what we are seeing. The second thing is what I believe very strongly, and I think the reason why we are seeing a simultaneous rise of buy now, pay later around the world is this population of millennials, urban millennials who have some disposable income, are actually a horizontal consumer class, meaning these people in Bangalore are no different from their counterparts in Mumbai or Sydney or San Francisco or London or Nairobi or Tokyo. So they're the same people. They're using the same products like Spotify, Netflix, Amazon, Uber, etc. They have the same phone. They're looking at Instagram, and they have the same level of expectation of user experience and service quality, right? And those people, just want the world-class product, right? Doesn't matter where you live, right? So I think that is one important macro driver, I think, which is driving the rise of buy now, pay later around the world. And naturally, I think what we are seeing in slightly more mature market, like perhaps Australia, is that perhaps the initial adopters were millennials, but the product is clearly better, right? It's transparent, and it has a defined payment period, right? You can't just keep on revolving and pay this high interest rate. So, it's good for millennials. They are obviously the early adopters. Then I'm sure, the older folks, like some of us on the call, will also adopt the product. And I think in some more mature market, we are seeing this, right? Now coming to India, and I'm sure these are some of the moving parts in some emerging markets. So what is happening in India is something quite interesting. So, you have only 29 million unique people who have a credit card, compared to 500 million people who have a smartphone connected to the internet, and almost 900 million people who have a bank account and debit card, right? Or a way to make a debit payment, right? And consumer retail is very quickly moving to the mobile platform. So people are buying online, yet 70% people still use what is called cash on delivery to make payments for things they buy online, right? Whether they are using an Amazon or Uber or anything like that, right? And the question is why, right? Why in spite of the fact that everybody has a bank account, they use cash? And the reason is, I think what Simon pointed to is trust. People want to feel in control of that buying experience when they're especially buying online. And typically in mature markets, credit cards give it. When you have a credit card, you get buyer protection, fraud protection, etc. But with debit, it's your problem, right? So one of the things that happens very regularly in India, in the the physical world, is this concept of khata. So I live in a building in Bangalore, and there are a lot of stores near me. There's a milkman, there's a newspaper guy, there's a grocery store, there's a pet store, and they all run a tab on me, almost like a tab, like tabby, right? In Hindi, it's called khata, and in some parts of India, it's called udhari. But whatever you call it, basically what it is I, as a consumer in my little market, in my neighborhood, can use my trust, right? The fact that I know each other as a payment instrument to get access to the store without even spending money, right? And khata is a buy now, pay later equivalent, but it allows consumers to transact with more control and with a high quality consumer experience, right? So, what we are building, therefore, in India is taking the concept of the khata, which the market is used to, but taking it to the world of internet, and of course using data and machine learning to solve for inherent risk in a business model. So that's kind of like the moving parts in India, where very few people have credit cards. Pretty much everybody has a bank account, and a lot of millennials or every millennial consumer, which is about 75 million people in India now, have very high expectation of user experience and transparency from their financial products.
Well, thanks, Nitya. That was incredibly informative, and actually, I know very little about what's going on in India, so that was great. Hosam, I'm going to switch to you. So while, and I'm going to play this whole trust theme a little bit further, right? If you actually read stuff which is written about BNPL, and I think, it's my favorite pastime these days, there's a lot of conversation regarding the opacity of the product and that, it's unfair. It's leading people to buy stuff that they never should or could or would, and a number of people are sort of defaulting. So what I'd like to hear from you is two things. One is it as opaque as people sort of claim it to be, and what specifically you, with a relatively new business or a new entrant, are doing about consumer education, consumer awareness, and not having them run huge debts?
Sure. So again, thanks for having us, Arjun, Ronit. So yeah, I think on this topic of opacity, I think if you compare it to what exists in the market today, which is credit cards, I would argue that credit cards are a lot more opaque than buy now, pay later. But buy now, pay later is very clearly designed to be extremely transparent to the consumer, right? We're very upfront, and I'm not speaking about Tabby here. I'm speaking about the market in general. We're very clear on what the charges are and are not to the consumer, right? In most cases, I think most of the players have taken a free for consumer approach unless there are late fees, and on the late fees as well, we're very, very clear on what those are. They're usually a fixed fee rather than a percentage, where there is, with percentages and with interest, there is a lot more opacity introduced. I think so. What exists today and the incumbents in the market are credit cards, and that's where the opacity is a lot worse. On the other hand, so Nitya mentioned, I think the customer experience. I think what is essential over here and what is a key driver for the adoption of buy now, pay later we've seen is the convenience for the consumer, right? It is just simply a much more convenient payment option than what exists elsewhere. I look back 10 years ago when we were starting e-commerce in the region, and the biggest question we got from retailers in the market was, why would customers buy online in a market like, say, Dubai, where there's a shopping mall in every corner and people just enjoy going to stores? I think back then as well, it was convenience. So convenience is really a driving factor towards the adoption of these solutions. And where there is convenience, you'll see the adoption, and where that stops being a part of the offering, you lose out. Right. So one final thing to touch on over here is the cash on delivery piece that is common in India. It's very common in our market as well. So only about a year ago, 60 to 70% of e-commerce transactions in the region were still happening via cash. And what we've seen, so COVID has obviously changed that somewhat, but not to a large extent. We've seen that drop to about 50 to 60% from 60 to 70. But I think where we have seen people change the way they do things and the way they pay is once we've introduced a payment option that is extremely more convenient and valuable to them, namely free installments, customers have started to shift, right? So that trust element is addressed, because now I'm only paying for what a portion of the total transaction value. And I'm not paying fully until I get the order in my hands, and so the onus is on the retailer to get it to me. But then as well, the fact that we're very clear on what the payment solutions are improves the overall convenience and transparency of the overall product.
And I just wanted to pick up, Arjun, if I can, just on that trust piece and the debt piece. I think looking at the market, credit cards and buy now, pay later, I think there is absolutely a narrative around bad debts. But when you scratch the surface, and I know in looking at some statistics in Australia, less than 1 in 100 customers pay late on Zip, compared to 1 in 5 on a credit card. And when I look at Zip as an individual business, I think every single customer that's transacted on the platform has had a credit check and an ID check, so we know who they are and we know whether they've got credit worthiness. And so, responsible lending has been a big part of Zip's story, and I know it's a big part of other players in the market. So I think that sometimes there's some statistics that are discussed in the press or externally that may not reflect the reality of all players in the space.
Let me switch now from the consumer perspective to sort of the merchant perspective. Ronit, do you want to take this question on?
Sure. Thanks, Arjun. Maybe we can bring Hosam into the conversation again, particularly given your own professional experience. Your founding experience has straddled both sides of the fence, both building an e-commerce company and now a BNPL company. What is the pitch to the merchant? We've talked about the pitch, the consumer, the global millennials that Nitya talked about, convenience you've talked about, but how do you onboard the merchant, particularly as the merchant is paying for the service?
Sure. And funny enough, I was pitched buy now, pay later as a retailer only 2 years ago, right? And I think there was a couple of things that were quite important to me. I think the financial stability of the BNPL provider was obviously of big importance, especially as a relatively larger retailer. You just want to make sure that the BNPL player has the balance sheet in order to be able to pay and support the transactions that are happening on your platform. But I think what really turns us on as a retailer, or turned us on as a retailer, is a couple of things. One of the biggest costs that we have as a retailer is acquiring customers, right? It's a extremely costly piece of the business. You look at the overall P&L of an online retailer, you're spending money on customer acquisition, on inventory, and on operations. And to many retailers, customer acquisition is probably the highest cost. So when we go to a retailer today, what we say is we are basically the cheapest customer acquisition tool that you can get, right? Your customer acquisition tools today are either you spend money on marketing, you go and pay Google and Facebook a ton of money to bring traffic to your website that may or may not transact, or alternatively you discount, right? And you spend a lot of money on discounting, which we can argue about the long-term sustainability of a discounting model and whether that works or not. And in both of these cases, you're probably spending about 10 to 20% of your revenue to move the needle at all. What we're saying here is we are able to change the consumer behavior and allow you to acquire customers significantly more cheaply than that, right? By offering them payment solutions that are very valuable to them and allow them to transact and convert a lot more easily. Moreover, we're also able to increase the overall spend or the average spend for a consumer because this consumer now can spread their costs over a longer period of time. So the value propositions are very clear. And I think as long as you're working with a buy now, pay later player that is able to stand behind those, then it really is a no-brainer to provide that to the consumer.
Hosam, can we just dig into a little bit more the 2 points you mentioned? The first one was funding, because you said when initially you were pitched, you weren't sure about it was an important factor. So how do you, I mean, I know it's a new business, you Tabby, but tell us a little bit to the extent you can share about where your sources of funding come from. And secondly, also, for the folks who don't know BNPL very well on the line, just spell out, what do you mean when you say you're a client acquisition sort of tool for the merchant, particularly online?
Sure. So I'll answer the second question first. So basically, we sit on the checkout as a payment option, right? And when a customer goes and shops online, there are various factors that affect their ability to convert or not, right? Once a customer gets to the checkout, there's usually a relatively high degree of drop-off by the consumers for various factors, right? I changed my mind, I don't want to spend, I don't have the money, or whatever it is, right? And what we're trying to do at the checkout is improve the portion of consumers that actually end up transacting. And the way we do that is by saying we're giving you free installments, right? The ability to transact without having to pay the full value right there at checkout. So that's what essentially we're doing, is improving conversion at the checkout and the overall spend of the customer. Now back to your other question on funding. So there are various ways of funding this business. I'll speak for ourselves as a buy now, pay later business in a relatively new market, relatively new business as well. Early on, you're going to have to fund via balance sheet, or more likely funding via balance sheet and via equity. It's obviously not the most cost-effective or the most efficient use of capital, but it's for many startups one of the only uses of or ways that you can fund the balance sheet early on. Over time, that shifts, right? And as we saw in our funding yesterday, a portion of the funding was now debt, and debt providers become more and more comfortable lending to us as we grow our business, as we show them traction and a performance of our lending book, and also as we raise more equity, they become just a lot more comfortable lending to us. So that's just generally, I would say, a journey in the lifetime of a buy now, pay later player. Early on, it is largely equity, and over time, it starts to shift to other forms of capital.
So congratulations on the fundraise.
Oh, thank you.
On that, and we should have said that early on.
David,
can I? Yeah, we should have. Sorry about that.
No worries. Thank you.
You didn't plug us enough on that, so you should remind us that. David, can I bring you in from Singapore? I think two questions. I think the first one is exactly the one which we asked Hosam in terms of sort of funding, and is it any different for you in Singapore? And obviously you're part of a very large business called Advanced AI. And I think where I'd like you to follow on with that question is part two of the question is, and I think I want everyone to sort of chime in or pipe in with this, is this sort of $1 million question around, how are BNPL players going to make money, right? Because there are all kinds of numbers out there. I'm not trying to ask you guys to share your secret sauce, but how and when are you guys, or are you already making money, and how does it all kind of stack up? So David, over to you.
Okay, thanks, Arjun, and hello everyone. It's a very good question. I think everybody around the global, the buy now pay later, the economics is pretty straightforward to calculate. Right? We charge a merchant fee, we charge MDR fee from merchants. But on the other hand, we need to bear quite a few costs, which, for example, includes the payment cost and the funding cost, because we pay upfront to the merchants. And also we need to bear the credit cost. And so the math is very pretty straightforward. And in different regions, these three costs have a totally different numbers. I would say, for example, in Singapore, in Western countries, the credit is very good, so that the credit loss is pretty small. If you look at, say Afterpay, those the release, the credit loss is below 1% for sure. And for funding costs also depends on different countries. The developed countries would have a relatively smaller funding cost, but developing countries, especially say Indonesia and some other countries, the funding cost is pretty high. And the payment cost is also different. Some countries, they have a bar on the interchange fee, but some countries does not have such a regulation. So the interchange fee itself could be at least 1.5 or even higher. Okay, so I would say the buy now pay itself is in some places it's pretty tough to make profit, to be very honest. This is the biggest challenge, when we pitch to merchants, they always ask us, hey, why you guys charge such a high MDR? And our cost is really high, we don't have choice, right? But on the other hand, I would say that the buy now pay later is a touch point for us to connect between customers and merchants. And the ideal way is the business should extend. After this buy now pay later, I believe different platforms have different extensions. Some may go as a marketplace, where gradually you are able to charge the take-up rates as a marketplace, as a bunch of Amazon, eBay, those the e-commerce, what they do. And alternatively, people may go to the financial services, right? So you have customers, you may cross-sell to banks, or even cross-sell to lending. It's another alternative source of revenue. And also may go to the different payment method as a issuer. So I would say those are the potential in the future for monetization.
And your question on regulation. So where do you see starting with Singapore, which tends to be most efficient from a regulatory perspective? We've seen something in Australia. I think there was a review earlier in the year, and I think Simon can correct me. And I think the decision the regulator made there was, for the time being, they weren't going to regulate. What's the view in your markets that you're covering in Southeast Asia or Asia?
Okay, so Southeast Asia is a one region, with the 10+ countries, but every country has a very different regulation, and also user persona, user demographics also very different. Normally, we either start with a factoring structure, or we already have a certain licenses. For example, we have a multi-finance license in both Indonesia and the Philippines. So in order to operate this buy now pay later business, I would say the regulator, they are all together with us to observe and to monitor what's going on in the markets. Eventually, my thought is they would encourage buy now pay later, but on the other hand, they would do to some extent to start regulate because in my opinion, buy now pay later is something better than credit card. But the credit card is somehow it's encouraging spend. But no matter how much I spend every month, I only need to pay a very small minimum amount. So it's encouraging. But buy now pay later is different. So whenever there is a late, whenever there is an overdue, the account is freezed so that you are unable to use until you repay back. So it's something that's really avoids such overdebt. That's why I would say that from a regulator perspective, it's encouraging, but they watch very closely to see how to regulate.
Arjun, can I jump in here on that credit card point, if it's okay with you?
Please, please.
David, could you talk a little bit more about that? Like many of the other panelists, you've mentioned why you think your product, Buy Now, Pay Later, is superior to credit cards. Could you talk a little bit about how the BNPL product is settled? Because one question we've had today, and we've also had in the past, is, are people using their credit card to settle BNPL loans? So this is simply the start of a credit card product. So if you can just comment about the debit card settlement, credit card, direct to bank account, through a wallet, and also how the charge structure works. Because if you use a credit card here in Dubai, I'm then paying a couple of % MDR on top of that.
Okay, so basically, very good question. And in Southeast Asia, because of, again, different region, very different, different country, very different. And in Singapore and Hong Kong, I would say that still it's dominated by both credit card and the debit card. And it's a pretty surprising that the penetration, the usage of a debit card is very high. It's very surprising, even in Singapore. But for other countries, in Philippines, Vietnam, Indonesia, the credit card penetration, I believe that India is the same. The credit card penetration is only 3%, very small. And even the bank account penetration is 50%, meaning that more than 50% people, they even don't have a bank account. And what Buy Now Pay Later does is, to work with e-wallet. So this is an alternative to do the KYC as well as do the repayments. Even for some countries, we don't need people to have an e-wallet. They just, the after KYC, and they repay, via say convenience store, 7-Eleven, or other methods. So it's a very localized solutions in order to serve them by this Buy Now Pay Later solution.
David, could you just spell out which countries would you have an e-wallet as a settlement for BNPL? So is it Singapore is debit card more than credit card for settlement? If you could just go through the major countries.
Okay, let's say, yes, exactly. Singapore, I say it's a debit card and credit card. It's a pretty straightforward, okay? But for Indonesia, for example, we integrate with all the major e-wallets in Indonesia. Say Gojek, GoPay is by Gojek, and OVO is by Grab, and Dana is by the Ant Financial. Okay, we integrate with all those. And in Vietnam, for example, we integrate with Momo, which is the biggest e-wallet in Vietnam, and ZaloPay. So we pretty much in every those developing markets, we look for the integration solution with all the major e-wallet providers.
Got it, thank you. I don't know if any of the other panelists wanted to pick that up, if Simon, others wanted to pick up that point about, or Nitya, how you settle the BNPL transaction.
Yeah, would love to add some color there. So in our case, what we see is 80% of our customers just do not have a credit card. And therefore, typically the settlement happens through what is called UPI, Unified Payment Interface, which is like an ACH equivalent, but real-time 24/7 and very high quality infrastructure. So 80%, roughly 75 to 80% of our customers use a UPI instrument. About 20% of our customers do use a credit card. Now, which is interesting, right? One of the ways we are perhaps different from maybe some other BNPL companies is we are actually currently focused a lot on micropayments. So we do not, most people use Simpl to buy food delivery online, grocery online, some clothes online, buying movie tickets online, maybe taking a taxi to the office or to the airport, those type of things. And it's solving a convenience, trust, high control use case as an alternate to cash on delivery, right? So that's kind of like, so of course, that means that the limits and amount of money that people spend per customer is relatively small. 20% people do use a credit card to pay back. And the interesting thing is those people find the user experience. I mean, it's very clear they're not financing the taxi ride to the office or a food delivery to their house. They're just taking a user experience, right? It's just an easy one-click checkout. If there is a refund, it's real time, and they just feel in control of a transaction, right? So, I'll give an example, right? Whether you have a credit card or not, in India at least, if you pay online, first of all, you have to go through multiple clicks and factors of authentication. So it's not one-click checkout at all. The second is because there are so many hops, 25% transactions on mobile just fail. So that's the second problem. Now, third is if there is a refund, then you will get an SMS from your provider saying, we have processed the refund and it'll appear in your statement anywhere between 5 and 14 days, right? And imagine you've done a $5 transaction and the mental math you have to do, right? Whereas with Pay Later, like Simpl, one-click checkout, right? All your transactions in one bill, just pay one bill, and get the buyer protection features like PayPal, whereas real-time refund, chargeback protection, et cetera, right? So that's kind of like, and that's where I think one probably an interesting conversation to have, generally speaking, in the market is Pay Later. When you think about it, it sounds one thing, but really the way consumer uses it, I think is divided into 3 large chunks. The first is as Hosam said, Pay Later for trust and convenience, right? So that's kind of like what we focus on a lot, right? So people are using Simpl to buy now, pay later, so that they have more trust in the transaction, they feel safe and control, and it's just convenience, right? And then, and of course, that means small transactions that people do frequently. That's food delivery, grocery, and so on. Then there is a element of balancing of budget, right? Where, hey, I want to buy a pair of shoes, and I would rather, pay 1/4 of it right now and then remaining later. But I'm not kind of like saying, hey, I just want to spend a lot of money to buy food because, or to buy shoes because I don't have money. It's just like helping you balance your budget, right? It's not real and loan. It's really, spreading your cash flows. And then Pay Later for pure affordability, which is also important, where you're buying your couch or you're furnishing a house or buying, expensive stuff, right? And those are 3 distinct use cases with 3 different value proposition, obviously business models, and how consumer actually consumes the product, right? I mean, yeah. So I think that's super important to maybe divide into as we think about Pay Later as a future of payments.
Ronit, I'm going to pipe in. I'm going to stay with this theme of credit cards versus BNPL. Simon, if I may bring you in here. Okay, so I hear all kinds of statistics. Some say BNPL is as small as 1% of the current consumer spend. Others give it a slightly higher percentage. Irrespective, it's a growing percentage, and I think it's a rapidly growing percentage. And let's be honest, it is. I'm not convinced personally that it is an intermediary product for credit card. I think I agree with sort of Nitya's view that only a small percentage of people are using their credit cards to pay off their BNPL installments, or if they're not, then at least my advice to all the participants is that is not the right way to go about it. And it is that's sort of my ticket to heaven for the day. Let me pose the question to you. How do you see banks who find credit cards as fairly profitable products, and especially in our part of the world where Hosam's aware, where APRs are at 40% and there is late fees and interchanges sitting at nearly 2%. What response are you already seeing from banks, and where do you think this is going to go in the next couple of years? And then please, anybody and everybody on this call pipe in, because I think there are some interesting variations to the theme.
Yeah, I think from Zip's perspective, particularly here in Australia, we've always seen ourselves as more of a competitor to the credit card or the broken credit card model than just buy now, pay later. And just to touch on the conversation a bit earlier, the majority of accounts in Australia are funded by Zip accounts are funded by debit cards, not credit. And on a macro view, what we're seeing is a steep decline in new credit card applications and credit card accounts. And so you can sort of see a shift from credit to buy now, pay later, as opposed to being an intermediary, as you said. But specifically to your question, Arjun, many large banks and payment organizations are now entering the buy now, pay later space with new offerings. And I guess there's a couple of things. We see that as really great validation of the work that we've been doing for the last 7 years in Australia and more recently around the world, and great validation that consumers are looking for more transparent credit in a better experience. And what that does with banks moving into that space, it really puts the onus on Zip and players in that market to continue to innovate and build products that consumers love and drives incremental sales to merchants. And so ultimately, ultimately, there's a reason, and when we look at Australia in particular, there's a reason consumers are moving away from more traditional credit products. And so I think that we're going to see both the banks, traditional players, continue to want to be in the market of buy now, pay later, because as you said, credit has been a profitable part of their business for a long time. So I think we're going to see, new players continuing to drive more innovation, better experiences, and we're going to see the banks responding to that by, responding to the market shift where people are moving away from credit to a different product, be it buy now, pay later. So I think we're just at the beginning of a shift from the banks to come and compete in this space, and ultimately we sort of see that as a good thing for consumers and retailers. The more competition, the more innovation, and the more that the players in this space need to add value to consumers and merchants. So I think there's a long way to go out, and we'll see a lot more people in this space over the coming years.
Arjun, do you mind Arjun, can I add a couple of comments there?
Please go ahead.
So one of the things when I started Simpl a few years back, and before that I had never worked in payments, so it was very new to me. And as I was learning, one thing that really appealed to me was, the first was that, this realization that this thing that we call the credit card, when you think about it, it was built in the 1950s and 60s. Like the whole thing was actually invented almost 70 years back, and we are even to this day using it in almost the same form. And when I say the form, obviously it used to be a piece of paper in the 60s probably, and then a piece of plastic, and then a barcode, and then metal. But the value chain, what is called the four-party value chain, is kind of like the driver of the product, right? Now, when you think about it, 60 years back in the 1960s, it was a disruptive innovation, right? You could actually use a piece of something and buy stuff. But if you fast forward today, in the world of internet, mobile, everybody's connected to each other, and ask some fundamental questions. And that's, when I asked those fundamental questions, two things really jumped out was, I think to me, build that conviction that there'll be a shift from credit cards in the world. The first was, who are the main customers of a credit card, true customers? It's a merchant who accepts it and a consumer who uses it. So now when you think about it, when I swipe a credit card at my coffee shop, the merchant is paying 3% for that transaction. And if you wonder where is this 3% going, you'll realize 2% is going to my loyalty points. But who does it build loyalty to? Well, the bank. Who's paying for it? The merchant, right? So it's a real, this four-party value chain really shifts a lot of value from retailers and gives it to the consumer for the benefit of issuers of credit card, right? So you see that. The second thing is on the consumer side, right? And as we have discussed, the problem with credit card, in my opinion, is that one, it gives you a very high limit, right? So it'll give you a $2,000, $5,000 limit. And then it makes it very easy for us to revolve, right? Psychologically, we do not understand. We all know each time I revolve my credit card balance, it feels nice to pay the minimum balance and just I'll pay next month. But what we are not able to, account for as human beings, normal consumers, is 24% interest rate compounded is financial suicide. Like, we just don't understand that, right? And that's why we all run into this problem of credit card debt, because it's just incomprehensible for the human mind to understand what this even means, right? And it feels nice in the short term to pay the minimum balance, right? Which is where, in my opinion, the opportunity is, right? And I think the long-term opportunity for buy now, pay later companies and products is to align themselves better from economics and long-term alignment between merchants and consumers, right? So for instance, right, as Simon, Hosam, and David has pointed out, the structure of buy now, pay later fundamentally is better, which is, first of all, it is a defined timeline, right? You cannot kick the can down the road, because as human beings, we want to procrastinate, right? And this product is built to have the guardrails where there is no procrastination, you have to just pay off. And if you don't pay off, you can't use, right? So by design, it cannot get you into that much of a trouble like a credit card does, right? And then second is the amount of money that is given to you is so small, right? I mean, you can't dig yourself into a debt by spending $100 or even $1,000, right? Whereas I think the statistic says in US, an average credit card balance is $40,000 US, compounding at 24% interest rate. No one is getting out of that debt ever.
So Hosam, your view, mate, and let me ask a very simple question. If you guys are out there to possibly disrupt the four-party model, why are all the BNPL players partnering up with the Visas and MasterCards then?
Sure. So I think, yeah, just on the topic of the banks as well. So one issue fundamentally, just due to the way that banks work, is that they are biased, right? They are biased parties. When a bank wants to offer or create a buy now, pay later solution, they are creating it for their customers and their customers only. So, for a typical merchant, it's not as attractive to go and offer buy now, pay later for this particular bank's customers or that particular bank's customers, and keep everyone else out. So I think that's one fundamental difference as well that we have as a buy now, pay later ecosystem, is that we're just unbiased parties willing to work with everyone within that ecosystem. So you asked a question on why do we want to work with the Visas and MasterCards. I think these are currently the rails that are available to us. Obviously, as the rest of the gentlemen said, there are other rails that are becoming more and more available to us. I think less so in a market like the Middle East. I think we're still getting there. We're starting to see the early days of open banking and wallets and so on. But I think we're still in those very early days. So today, that's the rail on which we're working. And the more that we can work with them to create products for the future that disintermediate, the better for us and better for them. I think what we don't want to do is complete separate from what exists today in the market with the existing players. I think sorry, one point to discuss over here is just partnering with these banks. I think is in our best interests. Because they have the customers, they have the rails, and they have the funding. And I think for them, partnering with us just gives them that longer term sustainability, offering these products to a broader customer base than they can today.
Ronit, for you, mate. Next question.
Actually, there's a question that came in. There are loads of questions coming in. And Hosam, maybe there's one that you could pick up here that's come in. That says, why would a creditworthy customer go for a BNPL in the UAE, as presumably she or he would already have a credit card from a bank? So what's the kind of for the consumer the use case? And similar question if others want to pick it up as well.
I think the simplest use case is just the fact that most credit cards in this market will charge an interest for an installment product, right? In some cases, there are exceptions where there will be a direct agreement with a certain bank's credit card on that particular retailer. But in most cases, the customer will be paying fees to avail these installments, right? And more than just the interest fees, there are what we're seeing a lot in the market today is a initial transaction fee. That's a fixed fee. There are cancellation fees if you want to pay your installments early. I mean, it just adds up and adds up. And I think where we come in is just say there are absolutely no fees. Just pay on time, and you pay exactly what you purchased.
So your client in Dubai or in Abu Dhabi, they could well have several credit cards. They're choosing to use your product because it's a better product for them in terms of cost.
It's a much simpler product in terms of usage, and then also better in terms of cost on the whole, right? What you don't want to do, or what's just not a great customer experience, is I come into a website and try to figure out whether my particular credit card is going to charge me additional fees with this particular retailer, as opposed to just saying, it's a one size fits all. Wherever I go and use Tabby, I know exactly what I'm paying for.
Got it. Simon, do you want to jump in there? I mean, Australia has a very big credit card market like the US. I mean, to what extent is the growth of BNPL being driven by folks who didn't have access to higher credit limits, that this is a way to increase credit availability, or is it substitution, that these are people who could have used their credit card and chosen to use BNPL?
Yeah, I mean, I'll sort of come back to something that I think Nitya mentioned and Hosam earlier, that the experience, and I did my own tests in the last month around applying for buy now, pay later credit in Australia, and I applied for a number of credit cards, and the experience is worlds apart. I can download an app, do a credit check, do a credit score, ID check, and have a certain amount of credit available to me instantly or thereabouts with a buy now, pay later platform. I do it all in the palm of my hand and it's done within minutes, and I can shop and transact almost immediately. I've applied for 2 credit cards just for my own personal testing. And, both would make a phone call, both asked me to email documents, both still 7 days later haven't given a decision on what the credit card would be. And when I went looking for what the fees were, I couldn't, it was almost impossible for me to get a handle on what the fees would be when you think about interest and late payments. And then when you get into the process of payments, and it's just a totally different experience. And I think, I think someone mentioned earlier that with the rise of I worked at Uber for 6 years before this across Southeast Asia. With the rise of apps like Uber that puts transport in the palm of your hand, people just expect that same experience in other verticals now. And if you can summons a car with the push of a button, surely you should be able to summon some credit at the push of a button, be it online or be it an app. There's different ways to do that. So, I really come back to the experience of it, and the players in this space, call them startups or scale ups or whatever, put the customer first and make the experience really great. Where I think the banks and the more traditional credit agencies are probably struggling a little bit with that, based on their size and the infrastructure that they have.
And in terms of credit experience, Simon, does it vary dramatically between the different markets you've seen?
In terms of the application process,
credit loss,
the credit loss. We're in 3, I guess, to some degree similar markets: US, UK, Australia, New Zealand 4, and interest in South Africa. Not too dissimilar. There is a difference between the life stage of the business, as well as it's earlier on as you're getting your decisioning and your fraud right. You improve as the business matures a little bit. And so obviously we've been around for 7 years in Australia. Our quad business in the US is 2 to 3 years old now. So there's an element of just the life stage of the business and how much you've been able to learn in market. But from what we can see in the market, so we're in, there are some pretty similar trends in terms of loss and default. And as I said before, that Zip has from the onset been about responsible lending. And so, we're really pleased that we've got really market leading metrics in late payments and defaults. It's as low as anybody's, and so we'll continue to drive that responsible lending position in the market.
I want to bring David into the conversation because, David, you operate in Southeast Asia, is such a heterogeneous, varied market. Can you talk a little bit about the credit experience in the different parts of the different countries you've operated in, or you see competitors operating in terms of credit loss experience?
Okay. It's again, it's the very two groups of the markets. One is the developed, Singapore, Hong Kong, and so on. So that's where, in terms of the credits, so pretty much, the entire KYC application process extremely simple. Pretty much only your ID number, your phone number, that's enough. And the process extremely seamless. And essentially, there are no credit check. And everybody is qualified for buy now, pay later. But for some other countries, especially the developing countries of Vietnam, Philippines, and so on, Indonesia, it's not the case because, on one hand, their income is very small. In those countries, people, the average income every month is less than $300-400 a month. It's very small. And on the other hand, because of the infrastructure, the payment infrastructure, so that's the repayment is a big hurdle. So that's because of all those requirements in those countries, we may need to do some, a more, comprehensive KYC process. So that even we can check the bureau data for the application. So this takes a more, a strict process, and certainly the risk in those countries would be much higher than the developed markets.
Okay, so sorry, go ahead.
Sorry, Arjun. I was going to say, if David could just talk a little bit more about the date, in terms of whether it's for the credit process, whether it's for the onboarding process, but a lot of your clients in the emerging markets are non-bank clients, or non-credit card clients. So we've had a few questions come in from listeners, from viewers asking about alternative data sources and so on.
Okay, so because in those markets, we first it's the original KYC data, right? This is what's the information submitted by the customers. In addition to the KYC data, we also use the third-party alternative solutions in addition to bureau data, such as the telco, right? The social media, the social data, and the transaction data. Those are from third-party providers, so that help us to do the risk underwriting. And in addition to this, one very interesting thing that we figured out is the behavior data on our mobile app. So when the user submit application, they need to do some inputs, but they may or may not. In every application, in every transaction, there is a terms and condition. Whether or not a customer clicks that button, that's a terms condition, and whether or not they read the terms and condition, this will be a very important feature, for our risk underwriting. So although, and when you input your name, and how long you input, when you input your phone number, how do you input, and those behavior kind of also one of the the features that we use in our risk underwriting model.
That's interesting, David. Thanks a lot. Guys, anybody else wants to pipe in terms of what sort of data sources you are using in your markets to make your credit decisioning? Because I think that's definitely a part of, as Simon said, responsible lending, right? You don't, however small an amount it is, and Nitya, I think you mentioned that the amount is small and you're guardrailed, but any interesting data sources that you guys are leveraging to make decisions? Again, you don't have to reveal your secrets here, so if you're comfortable to share.
Yeah, Arjun, let me come in quickly there. So I think one thing really, I think for us to think about how our unit economics work is, of course, data, the underwriting, and of course in India, unlike probably other developed markets, our bureaus are relatively new and they have thin files, and therefore a lot of consumers who are actually good consumers just don't have the data, and therefore you have to find alternate data points like telco, historical transaction data, and behavioral data so that you can find the right consumer. But I think one thing I would want to double click again, because I think it is probably the least discussed part of the driver of the business model, which is again the consumer experience. So let me just come again, because I think Hosam and Simon definitely touched on it. What happens when you are thinking consumer experience first? Of course, you have to do all sorts of underwriting and data science and machine learning. But at the top of the funnel, when you have a great consumer experience, two things happen. The first is you have a self-selection of consumers who are opting into your product for the user experience element of it, as opposed to a consumer where you are the last lender of last resorts, right? So, if you're the lender of last resorts, naturally you have an adverse portfolio, and it will behave like, doesn't matter what your model say, right? And if you're a product or a consumer experience platform, then there is a different selection of consumers, and you can say yes and no accordingly. So that's number one. The second is what, when you think about consumer experience, I think it doesn't, obviously it starts at the beginning where sign up process and so on, but it's the entire life cycle. How are you in the life of a consumer fairly consistently, and at every touch point building trust and convenience and giving that user experience end to end so that consumer likes you. And the reason it's important is one of the big drivers of economics in this model is retention, which means if you are a company, like, if you're a company where, just to give you an example, at Simpl, almost 92% people who use Simpl in any given month are people who have used Simpl before and also have paid their bill on time, for instance, right? So what that means is as you are getting consumers, you are having more and more seasoned consumer. And of course, we all know in credit, losses are front-ended. And then of course, as seasoned consumers are there, the probability of default increases. And so what you need is high quality consumer experience, and whatever adds the element of user experience, which includes not only a nice slick interface or speed, but everything, customer support and the whole 9 yards, such that consumer actually starts using you very frequently And that is what drives the business model, right? That's where you make a lot of money. And of course, the new people will have their losses as you go on, right? So, of course, data science and all this stuff is super important, and everybody does that. But that element of high quality user experience and then positioning yourself to the right segment of the market so that you're attracting the experience seeker is super important, because that's when the selection of your customer is just positive.
So gentlemen, we are at the 1 hour mark. So I'm going to now sort of ask you guys to pull out your crystal balls and sort of give us, I think, take a minute each. And I'd like all of you to take a minute each. And then I think, we should talk about sort of doing some Q&A and wrapping up. Give me a view, throw your vision or your mind sort of 3 to 5 years from now, right? Two-part questions. What are the innovations that we're going to see in BNPL, right? And how prevalent will BNPL be in your respective markets? And obviously in Australia, it's a lot more sort of established in the next 3 to 5 years. And let me start with Australia. So I think we'll move geographically. We'll move with Simon. We'll then come to David, Nitya, and then we'll end with Hosam on that question, right? So Simon, over to you.
Very tough.
Yeah, 3 to 5 years. It's a tough one. I guess what I'll do is I'll sort of look at Zip and where we are, and that might give a sense of where we're going and not necessarily the market. I said earlier, we do believe that we're really challenging the broken credit card market as much as buy now, pay later. And there are some nuances and difference there. But, if I look at Zip's mission, it's to be the first payment provider everywhere, every day. And to achieve that, we're going to need to continue to innovate on our business model. And if we look around the world today, and we're only in a few, 4 or 5 markets, if we look around the world where we operate, we currently have a pay in for, pure play, buy now, pay later product. We have an account-based revolving credit product. We have a longer-term regulated product, Zip Money in Australia for larger purchases. And then we also do unsecured small business lending. And so, if I think about where we're at and what we're looking at going, I think that more products will evolve to maybe not just buy now, pay later, but if we want to create a great consumer experience everywhere, every day, then we need to provide that at multiple levels and different products. It could be to buy, your couch at a few $1,000s as well as your coffee for $4. And so I think that one product doesn't meet that requirement, the sort of paying for buy now, pay later type one. So yeah, I look at what we've got and look at our ambition. And I think we're just going to see that evolve to broader products, trying to touch more customers with a great experience. In doing so, continuing to add value to our merchant partners and that's where we started.
David.
Okay, so certainly, the current buy now, pay later, I think everywhere is still pretty the early stage, right? It's, as mentioned, just the very starting point to connect customers and merchants. And the next 3 to 5 years, I would say, it depends on whether you foresee this buy now, pay later is customer-oriented or merchant-oriented. Meaning that if a customer-oriented, then the focus is in the future, how to continue to serve customers from different angles, not just a transaction, but from other, potential, say, financial services, which is a credit card, a bank account, or lending. So this could be the huge direction. I would say this is more or less, especially for the developing countries, because a lot of people are still underbanked or unbanked. For the developed countries, more like mostly, I would say it's merchant-oriented. I mean, the angle or the future direction is how to better, how to continue to serve merchants, to provide more values to them in terms of new user acquisition, in terms of conversion, the CRM, all different angles, to provide them the omni-channel solutions to help them with this. I truly believe, that COVID completely changed the ecosystem of the retail. So that's how can we help them to make them this digitalization in the coming 5 to 10 years. This is another, I would say, another direction.
Thank you, David. Nitya, what's going to happen in India? And play out that whole debit card because there is a big sort of play with the banks on the debit card interest-bearing products and stuff. So, try and sort of mold that in your answer if you can, please.
So, it's to me, it's always hard to answer that three-year question. But let me try to answer a 10-year question, right? I mean, like, what happens in 10 years? I think I think I'm more clear about. 3 years is always who knows, right? So if I really think that, fast forward 10 years or even 20 years, something like that, and you look back, right? You look back 80 years, and I think we'll see 3 major disruption in payments, in the payment infrastructure wise, right? The first we'll see, obviously, in the 60s, credit card came, and that was a disruptive new thing, right? After that, we obviously saw something like PayPal. PayPal is obviously a big company, and there are so many versions of PayPal, which means you're connecting your bank account using internet to online retail, and you're connecting the dots, right? And I think, the more after that is something like Pay Later, which will be the replacement of the credit card, not something that is credit card after a credit card, but a true replacement for a credit card where your smartphone becomes the credit card. Right? How do you convert the smartphone to the credit card itself, right? Now, what does that mean, right? What does that mean? I think what that means is 3 things. One is it will give you credit for convenience, credit for balancing of budget, and credit for affordability, all stitched together in a seamless, cohesive user experience, but in one place, so that you can buy your coffee, as Simon said, or you buy your Peloton bike, right? Doesn't matter, one thing, right? It will do that. From a technicality perspective, it will price risk very granularly, right? So not only it will price the customer and price the risk, it will also price it in the context of the transaction, and it'll go deep into the SKU level of the transaction. Meaning, if I'm buying Bible, it is different from buying some gift cards, for instance, right? And it will be priced differently. And some of this we are already doing, right? So we are pricing based on oftentimes SKU. And then I think one thing that it will have, and which I think is super important, is loyalty rewards. But loyalty rewards built in a way which is not the traditional loyalty reward, which is you take a lot of money from the merchant through MDR and give it to the consumer to build loyalty for yourself, right? How can you be a platform such that the merchant can build loyalty with their customers, right? And we all know merchants have a lot of budget, as Hosam said, right? Marketing budget, retention budget, to give the customer. My coffee shop wants to give me 10% back each time, right? And if a mobile device can help consumers organize this in an easy way, and merchants want to give it to the consumer, to me, when you look at 10 years out, 20 years out, that's a true replacement to a credit card, and I'm sure it'll happen. It's a matter of time.
Yeah, I think there's very little that the guys have left for me to say, but I'd say what we're all striving towards is basically simplifying payments for the consumers that we and our customers. And I think the way we do that is just making our payment methods the most usable payment methods available to the customers in the markets that we're in. I.e., it's not just to split my payments or split my purchases into multiple installments. I want to buy my coffee. I want to buy my or I want to buy something bigger than that. And I think how do we get there is we get there by providing an incredible user experience that just engages that consumer, keeps them coming back, and makes the payment solution the most convenient way to pay. Today, it might be Apple Pay, but maybe over time, we start to replace those traditional payment methods with more convenient, longer-term installment payment methods like the ones we're providing today.
Ronit, I'm gonna hand over to you. We've done very good at time. We've got about 4 minutes left. I think it might be a good time for you to sort of think about maybe one last question out of the Q&A, and then we close down the call. Over to you.
Maybe we'll just pick up one question from the Q&A before we wrap up, and this can be thrown out to any of the panelists. We've had a couple of people ask about the financial model of BNPL. So not your profits today, not your revenues today, but in theory, the financial model. So this is what I get from the merchant as the kind of BNPL MDR. This is my funding cost. This is how, when you hit maturity, when you're pitching to investors, how profitable is this business or not profitable? Because as you can see, several people on the call are asking, are you guys going to make money, basically?
maybe let me take a stab at this. So I think there's obviously multiple revenue models that exist. Some mostly on the customer, some partially on the retailer. But let's say there is a revenue stream that is coming in from the transactions, right? Which is an MDR, and part of it can be funded by the merchant. In other markets, it is partially funded by the consumer. Below that, there are a number of costs, and the costs that we talk about today are the transaction fees. So when a customer repays, are there transaction fees for those repayments? B, there is a cost of funding, and the cheapest source of funding obviously is a deposit that a customer places with you. A more expensive cost of funding is debt, and a slightly more expensive cost of funding is equity. There is a cost of data as well. So the data that we are pulling on every consumer in order to score them and assess their creditworthiness. And finally, there is a cost of default, right? So a portion of customers just end up not repaying. I would say that these are the four main cost buckets that go into every single transaction. Obviously, aside from that, there's different ways that you can monetize, and there's different additional costs if you want to start pushing your brand out and marketing to the consumers more directly. But I think I've covered anything. I don't know if any of the guys have anything more to say here.
Does anyone else want to jump in?
Maybe I can quickly come in here. As Hosam said, right, that's exactly how the model works. And why sometimes maybe it appears like there is just thing. Look, think about this, right? Payments have been working, and it is one of the most profitable business models for banks. In spite of the fact there are multiple layers of value chain, all taking some money, right? I think what BNPL does is takes all the inefficiencies out and bring a full stack solution, so that you are basically taking all the inefficiencies out, and therefore there's actually a business model as long as you can control some of the cost factors, as Hosam said, losses, transaction cost of capital, and some of the operating costs and so on, right? But I think the reason, it may be counterintuitive, but really, if you think about it, all you're doing is just taking all the things that are clipping a coupon for not doing much, and you're replacing it with a more elegant technology solution, which is scalable, right? And therefore, unit economics are just not the same in a four-party model versus a full stack pay later plan.
Thank you, Nitya. We're sort of running fast out of time, so I'm going to sum up now very quickly in less than a minute. BNPL has clearly been one of the most interesting, exciting developments in 2020. We've got listed plays, we've got startups. Congratulations again, Hosam, for your A series that you announced yesterday. You've brought in new clients into the ecosystem. So David's talked about particularly in emerging markets, and also Simpl with Nitya, people who didn't maybe have credit cards. And you've also offered a more cost-effective way for existing credit card users, whether it's in the UAE or Australia, to get access to consumption. But the big picture, I think the big point you've all made is this is a better experience. This is better for the client. It's better for the merchant. And that's why you're all very bullish in your growth prospects. I'm aware we've just run out of time. We haven't covered all the questions that came in. But if you want to come back to Arjun and myself, if you're listening in, we'll try to deal with those questions, maybe Arjun and myself, and we'll try to get back to you individually. Thanks again for joining us today.
Yeah, thank you. I'd like to thank all the panelists and the attendees. And literally, there's, from the way I can see it, there's a part two, maybe in 6 months' time, when you guys have had when the rubber has been on the road for a little bit longer. So thank you, our panelists, and thanks a lot, our participants. And thanks, Ronit. It was good to collaborate.